Before New York built skyscrapers over Wall Street, before London became the city, there was a much smaller place quietly doing something far more radical. Amsterdam, a low, soggy patch of reclaimed land, didn't just join the modern world. It invented the rules of it: stocks, banks, insurance, speculation, financial bubbles, and financial crashes. The architecture of global capitalism was drafted in a city that sits below sea level, defended from the ocean by man-made walls. 400 years ago, Amsterdam should not have mattered. On a map of 17th century Europe, it looked like a footnote. The great powers were monarchies with crowns, armies, and empires. Spain, France, England. The Dutch Republic had none of that. No monarch, no sprawling colonies yet. No gold and silver flowing in from conquered mines. What it did have was something you can't dig out of the ground: a culture of trust and cooperation. The Netherlands was built by people who had to work together or drown. Farmers, sailors, merchants, and craftsmen learned to organize themselves to manage dikes, drain land, and keep the sea at bay. That same cooperative instinct flowed into their economy. They didn't expand by marching across borders. They expanded by crossing distances, turning oceans into highways and trade routes into a source of power. Every ship leaving Amsterdam carried more than merchandise. It carried paperwork, contracts, charters, marine insurance policies, letters of credit, and bills of exchange. These documents allowed a promise made in Amsterdam to be honored in Bengal, Batavia, or Lisbon. They turned trust into something portable. Capitalism in its earliest form was not an ideology. It was an answer to a practical question that kept recurring. How do you fund a journey that is too big, too long, and too risky for any one person or family to handle alone? The Dutch response in 1602 was astonishingly modern. A group of merchants formed the Verenigde Oostindische Compagnie, the Dutch East India Company. It wasn't just another trading venture, it was the world's first durable joint stock corporation, backed by a large pool of permanent capital. Before that, long-distance trade worked like a high-stakes lottery. Investors would gather a sum of money, send a ship out, and wait. When the ship returned, if it returned, they sold the cargo, split the profits, and dissolved the partnership. Then they started over. Each voyage was an isolated bet. Each failure could be total. The Dutch East India Company broke this cycle. Instead of raising funds voyage by voyage, it sold shares in an ongoing, long-term enterprise. Investors subscribed capital for years, not months. Those investors received pieces of paper, shares, that represented a slice of ownership and a right to a share of the profits. Critically, those pieces of paper could be sold to someone else whenever the shareholder wanted out. That single feature, transferability, changed everything. Trade became liquid. Ownership became flexible. You didn't need to risk your life on the open sea to participate in Asian trade. You could simply buy or sell a claim on a portion of the profits, all while standing on dry land. For the first time, wealth could be separated from physical labor and physical presence. Ownership became an abstraction that could move faster than ships and more quietly than armies. The amounts involved were staggering. The VOC, at its peak, was one of the most valuable enterprises in history, if not the most valuable by some estimates. It financed fleets, built fortified trading posts, negotiated directly with rulers, and sometimes behaved like a state within the state. It minted its own coins and fielded its own soldiers. But again, the real innovation wasn't the empire. It was the secondary effect, the market that formed around the shares of that empire. Those shares didn't stay in the hands of a few founders. They moved through the hands of hundreds and then thousands of investors. People bought, sold, and traded them based on rumors, reports from returning captains, wars in Asia, and gossip in Europe. A new pattern emerged, a constant flow of buying and selling day after day. Out of that flow came the Amsterdam Stock Exchange, the first permanent organized securities market. On the dam rack in the heart of the city, people gathered to discover prices. They shouted, bargained, speculated. News, accurate or not, rippled through the crowd and moved those prices up and down. For the first time, the value of a business was being continuously negotiated in public. In the shadow of church spires and canal houses, the idea of the market price as a living, shifting thing came into being. The Dutch had no need for the word capitalism. To them, this was simply good business. But the underlying architecture was already in place. Fractional ownership, standardized contracts, negotiable securities, and a constant tension between individual greed and collective trust. While absolute monarchs demanded taxes by royal decree, Dutch merchants raised capital by persuasion. Instead of, "you must pay," the message was, "you might profit." Taxes rely on authority. Capital relies on confidence. Authority stops at borders. Confidence can circle the globe. As this system matured, Amsterdam turned into something unprecedented, a city whose true power lay not in its walls or its cannons, but in its ledgers. By the middle of the 17th century, Amsterdam was the wealthiest port on earth. Its docks were jammed with ships from Africa, Asia, and the Americas. Its warehouses brimmed with tobacco, sugar, spices, timber, textiles, and silver. Its middle class commissioned portraits and cityscapes from painters whose works now hang in museums. Yet the real riches lay in paper, in carefully kept account books, and in balances recorded at a new kind of financial institution. In 1609, the city founded the Bank of Amsterdam. To understand how revolutionary this was, you have to imagine the chaos it replaced. Europe's coins came in every possible shape, weight, and purity. Many had been clipped or debased. Just counting money required expertise and suspicion. Merchants wasted time and lost value simply by moving coins from one city to another. The Bank of Amsterdam offered a clean slate. Merchants could deposit their messy mix of coins. The bank would weigh and test them, take a small fee, and credit the depositor's account with an equivalent amount of bank money. A standardized, reliable unit that existed only in the bank's books. Suddenly, trade could be settled by transferring entries in a ledger. Bank money became a trusted reference point across Europe. It was more stable than most coinage. It was backed by the bank's reputation and by the city's discipline. This was a critical shift. Value was moving from metal to mathematics, from physical coins to accounting entries. Trust in institutions was replacing trust in the preciousness of gold and silver. The Bank of Amsterdam became a magnet for capital. Merchants from distant cities opened accounts there. Governments looked to it for loans. Its balances were so respected that they functioned almost like a reserve currency, a 17th century version of digital money, long before computers existed. With reliable money, liquid shares, and growing experience in managing risk, Dutch financiers went one step further. They started to treat risk itself as a tradable asset. They crafted marine insurance contracts to spread the danger of storms and shipwrecks. They signed forward contracts to lock in prices for cargoes that hadn't yet arrived. They experimented with options that allowed people to bet on price movements without buying the underlying goods. In the coffee houses, inns, and open-air markets of Amsterdam, speculation transformed from a sideline into a distinct occupation. Some people made fortunes never touching a barrel of spices or a bale of cloth. Only pieces of paper representing claims on those things. It was exciting. It was profitable. It was dangerous. A new generation discovered that you could become rich by predicting how other people would feel tomorrow, more optimistic or more afraid, about the same underlying reality. They bet not just on goods, but on expectations. They learned to ride waves of enthusiasm and panic, and inevitably they rode those waves too far. The most infamous example came in the 1630s with tulips. Tulips were exotic imports from the Ottoman Empire, unlike any flower the Dutch had seen before. They were fragile and luxurious, a perfect symbol of status in a society newly rich from trade. Certain rare varieties became wildly fashionable. People began buying and selling claims on bulbs that were still in the ground, months away from blooming. What began as a niche enthusiasm spread. Contracts for tulips were traded the way shares had been traded, quickly, speculatively, with an eye on what the next buyer might do. At the height of the mania, a single exceptional bulb could command a price comparable to a fine canal-side house. The logic had floated free of the object. People weren't really buying tulips. They were buying the belief that someone else, somewhere, would be even more eager to buy tomorrow. Price became its own justification. Then, as always happens, belief wavered. Some buyers failed to show up. A few auctions disappointed. Confidence cracked, and the market did what markets do when confidence disappears. It fell straight down. Contracts that had looked like tickets to easy wealth turned into scraps of worthless paper. The crash of the tulip market was one of the first spectacular speculative busts in capitalist history. Amsterdam had not only pioneered modern finance, but also experienced one of its first great failures. Yet, this too fit into the pattern of Dutch pragmatism. They did not conclude that all speculation was evil. They did not abolish markets. Instead, they looked at what had happened and tried to understand it. They debated what kinds of contracts should be legally enforceable. They adjusted business practices. The lessons seeped into their institutions. The realization was sobering. Markets are expressions of human psychology, not just of rational calculation. They respond to stories, rumors, hopes, and fears as much as to real data. No equation can fully predict when enthusiasm will tip into euphoria or when caution will turn into panic. Modern capitalism, in other words, was born knowing that it was unstable. What Amsterdam built was not a perfect frictionless machine. It was a system with feedback loops, a system that could surge, crash, and adapt, a system that could survive its own mistakes by learning from them. Beneath the contracts and coins, the Dutch were also engineering something more subtle, a new moral framework. In much of medieval Europe, making money from money was morally suspect. The church condemned usury. Profit-seeking for its own sake smelled like greed. Wealth was expected to come from land and labor, not from cleverly written agreements. The Dutch quietly rewrote those assumptions. In their world, profit was not a sin. It was a sign of skill and discipline. Being methodical, careful with costs, and persistent in reinvestment became virtues. Religious ideas about hard work and modest living fused with commercial life. Being a successful merchant was not only socially acceptable, it could be morally admirable. This fusion of Protestant ethics with capitalist practice created something new, a culture where solvency and reliability were not just economic strengths, but moral indicators. Success began to be measured not just in salvation, but in balance sheets. The joint stock company in that sense was also a moral project. By allowing many small investors to join in, it looked more inclusive than the old world of royal monopolies. Risk was shared, opportunity was wider. For a time, the stock market could be seen as a kind of democratization of profit, but broad participation has a side effect. The more people are involved, the more emotions swirl around prices. Hope, envy, greed, and fear all get amplified. Volatility increases. That is one of capitalism's enduring paradoxes. The very mechanisms that spread opportunity also spread instability. By the late 1600s, Amsterdam's financial innovations had reshaped Europe's geopolitical map. The Dutch Republic became the banker of kings. States that once dismissed it as a minor trading nation now relied on its credit. Spain borrowed from Dutch lenders to finance wars. France used Dutch intermediaries for trade and financing. England tapped Amsterdam's markets to support its navy and its government debt. Power was flowing not just from cannon barrels, but from interest rates. In less than a century, history had turned upside down. Empires that once conquered by sword were now dependent on a small republic that conquered by ledger. Amsterdam's institutions, the stock exchange, the Bank of Amsterdam, the VOC, became blueprints. Other nations studied them, copied them, modified them. England, in particular, took notes. By the end of the 17th century, England was struggling under the strain of frequent wars, especially against France. Its government was deeply in debt. It needed a more efficient way to borrow. Looking across the North Sea, English politicians and financiers saw in Amsterdam a working model of what a modern financial system could look like. In 1694, England created the Bank of England. It was allowed to issue notes backed by government debt. Those notes circulated widely and became a trusted medium of exchange. At the same time, the state borrowed systematically from investors, effectively creating a national bond market. The Dutch template had been localized. From this foundation, London rose. During the 18th century, London gradually took over from Amsterdam as Europe's leading financial center. It built on Dutch techniques while adding its own. British policymakers realized that controlled, credible borrowing could finance not just survival, but expansion. Credit paid for a powerful navy, for global colonies, and later for factories and railroads. The logic of conquest shifted. Instead of we conquer, then extract resources, the model became we borrow, then invest, then conquer, then borrow more. Capital and empire became intertwined. Capitalism had moved from a defensive strategy for a small republic to the engine of a global empire. But embedded in this success story is a repeating pattern. Every society that masters credit eventually faces the dangers of over-reliance on it. Amsterdam showed this early. As the 18th century progressed, the Dutch Republic began to lose its edge. The same intricate financial system that had propelled it forward started to lock it in place. Dutch investors, seeking security, increasingly put their money into safe, interest-bearing instruments, loans, bonds, and annuities, rather than risky new enterprises. Capital flowed outward to foreign borrowers. Dutch lenders financed English projects, French governments, and even the young United States instead of fueling domestic innovation. Amsterdam shifted from being a place where new wealth was actively created to a place where old wealth sat collecting interest. In modern terms, it became a rentier economy. The result was predictable. While Amsterdam remained rich, it became less dynamic. New centers of energy emerged elsewhere. War and political upheaval did the rest. Napoleon's conquest was the final blow, but the decline had begun earlier in the balance sheets. Yet even as the Dutch Republic shrank in political importance, the system it helped create did not shrink with it. The methods lived on, transplanted to bigger stages. When Amsterdam lost ground, London took over. When London's dominance later waned, New York stepped in. Each new financial capital inherited and expanded the Dutch toolkit. Joint stock companies, central banks, bond markets, stock exchanges, complex contracts. Today's global economy, full of derivatives, algorithmic trading, credit default swaps, and digital currencies, is an elaboration of structures first assembled in that small, damp republic, and the mistakes repeat with eerie familiarity. Tulip Mania looks, in hindsight, like a dress rehearsal for later crises. The South Sea bubble in the 1720s, the crash of 1929, the dot-com bust, the subprime mortgage meltdown in 2008, the cryptocurrency booms and busts, all follow a similar emotional rhythm. Something new appears. It looks promising. Early adopters get rich, stories spread, skepticism turns to fear of missing out. Prices start to drive the narrative instead of the other way around. Leverage builds. People borrow to buy more of the rising asset. Then reality reasserts itself. Expectations collide with limits. The bubble pops. Different centuries, different technologies, same underlying human behavior. Each time, critics declare that this proves the system is broken. Each time, the system bends but does not break. Instead, it adapts. New regulations are introduced. New financial products are invented to hedge or transfer the newly discovered risks. New stories are told about how we've learned our lesson. In this way, capitalism digests its own crises. It uses them as raw material to evolve. The purpose is not to eliminate volatility. That would mean eliminating opportunity, but to stay alive through it. That is the genius and the danger of the Amsterdam model, a system that is designed, almost unconsciously, to survive its own self-inflicted wounds. Underneath the technical innovations, though, lies something less tangible and more persistent: the power of narrative. Markets are not just places where goods are exchanged. They are places where stories compete, stories about what is valuable, what is safe, what the future will look like. The Dutch were among the first to build an entire society around such stories. They believed that commerce could be more effective than conquest, that credit could be more powerful than coercion, that a small, disciplined republic could outmaneuver empires by being more trustworthy and more efficient. They were right, for a time. Their city was built on land that should have been underwater. Their wealth was built on promises that should have been fragile. They turned both into something durable by constantly maintaining dikes and constantly maintaining trust. That is the deeper metaphor Amsterdam offers to us. To hold back the sea, you don't build one wall and walk away. You monitor, repair, reinforce, adjust. You assume that pressures will keep rising and that nature will look for every weakness. Finance works the same way. You cannot design one perfect set of rules and declare the job done. You have to keep managing a system that is always under stress. The Dutch understood that the water never stops pressing. They learned the hard way that human desire never does either. Today, the pressures are once again enormous. Global debt is at historic highs. Financial markets are deeply intertwined. A shock in one country can ripple across continents in days. Enormous pools of capital chase returns in complex, opaque instruments. Digital platforms allow rumors and fears to spread at the speed of light. We live in a world where money can move across borders with a few clicks, where currencies can exist only as code, and where companies can reach billion-dollar valuations before turning a profit. In that sense, we are closer to 17th century Amsterdam than we might think, surrounded by intangible promises that everyone treats as real. The system that began as a way to share risk has, once again, piled risk up in new and surprising places. Which brings us back to the mirror. Capitalism is not simply a set of institutions or a collection of markets. It is a reflection of who we are, our ambitions, our fears, our capacity to cooperate, and our tendency to overreach. Amsterdam was the first city to polish that mirror to a high shine. When we look at stock tickers, bond yields, or crypto charts today, we are still, in a way, looking at our own psychology, just as the Dutch were when they watched tulip prices soar. The story of Amsterdam shows us both sides of the system it created. On one side, the ability to turn trust into wealth, to replace conquest with commerce, to finance exploration and innovation. On the other side, the tendency to confuse price with value, to believe that walls, financial or physical, can hold back tides forever. Capitalism did not emerge from a philosopher's study or a king's decree. It emerged from the muddy ground of a tiny republic that refused to be swallowed by the sea. It was built ledger by ledger, contract by contract, crisis by crisis. It gave us the modern world. It asks us still to answer the same question the Dutch faced. We can build systems on trust, but can we keep making ourselves worthy of it?